Good morning, everybody. This is one of the largest crowds I think we've had for this event. I think our count was about 150, and that's the good news because you're all very interested in the market and what's happening, around the world. The bad news for me is you all came to hear Pat, and just I got to do my best to just present his slides and just kind of summarize what our investment policy is. And I'll give you a quick story and a quick answer to Craig's question as to how you got me down here. I had two life-changing events in the last year, and one of them was several months ago I got in a pretty nasty fight with my wife, and it just went on and on, one of the worst ones we've had in a while, and at the end of the fight, I just said, I'm sorry, what can I do to make it up to you? And she looked at me and she points and she says, I want you to buy me something that goes from 0 to 150 in 5 seconds when I step on the pedal. I bought her a bathroom scale. And that led to the second life-changing event, and that is I lost the snowblower in the divorce and had to come down south here. Steve Greenstein's laughing at those. He's thinking to himself, those are really good. I wish I would have said it. Don't worry, Steve, you will, wherever you are. So anyway, what I want to do, we're going to summarize market conditions. I'm going to go through our investment philosophy and thought process right now and talk to you about what we think about the market, what we just went through in 2013, answer some questions that you might have had or lingering right now, and kind of give you a scorecard of how we did last year and what we think is going to happen over the next 12 months. And we've titled this Bull Market or Bubble because this is kind of the dichotomous question that everybody has on their mind. If you don't know by now, and Craig gave me a great introduction, I'm a senior portfolio manager for Sanibel Captiva Trust, working out of our Naples office. I've authored 3 books, and I've written a number of investing columns over the years. I joined the firm in 2002 first as a board member and has stayed as a Chicagoan until just recently because of these unexplained events. And as Craig said, I'm Southwest Florida's newest resident. Sanibel Captiva Trust, as you know, and as Craig mentioned, we're up to $1 billion in assets under management. We're not just asset managers anymore. We're not just stock pickers, although that's our bread and butter and that's what we enjoy. We are focused on delivering personalized portfolio solutions and trust and financial planning solutions and world-class service to all of you. So that's what we really pride ourselves on. Our agenda today is going to be pretty simple. First of all, we're going to go through a scorecard. To us, accountability matters. We want to know how we did last year. I'm going to review a few things of what we talked about, or Pat talked about at last year's presentation, and we'll see how we did versus what our predictions were. And then we'll talk a little bit about this issue of are we in a bull market or is a bubble forming. We're going to go through how we're investing now with clients' money, and this will take 2 forms. We're going to talk about how we've been generating income for clients and what we're doing to create long-term growth, preserve the wealth, and to keep the party going, so to speak, for a lot of your portfolios. First of all, I'm going to lay the cards on the table right now. We're not doing any forecasting. We're not making any predictions as to what the S&P is going to do this year, what the economy is going to do. We just don't spend our time forecasting or thinking about it. And we've learned in this business there are 3 basic kinds of people. There are those who know, and that's usually about 1 or 2% of the folks in the investment business. There's those who don't know, which is about 97%. There are those who know they don't know, and that's usually an extra 1 or 2%. And then we got the fourth, someone who knows he doesn't know, but will tell you anyway what his opinion is. You all know them, usually your brother-in-law, but sometimes we call them the market strategist. Anyway, how did we do last year? I'm going to go and review a couple quick slides that Pat put forward to you last year. One of the things we said was that U.S. stocks are very cheap relative to bonds. That was a pretty bold statement at the time, and it really outlaid our philosophy that we were going to invest heavily in stocks and stay the course, and that worked. The S&P 500 was up 32% last year. Bonds were down 2%. There was a 34 percentage point disparity between the returns of stocks and bonds, one of the widest we've seen in a long period of time. To us, it was very obvious that stocks were the place to be. We also said very succinctly, and to a lot of clients, we are avoiding bonds and we are looking elsewhere for income. And that worked as well. One of our alternatives to income was just put people in dividend-paying stocks that were yielding 3.5%, 4%. They were yielding more than the bonds. Those types of portfolios, which we call our equity income portfolios, they were up 24% last year. And our high income portfolio, which was our bond alternatives of master limited partnerships and bank preferred stocks, that was actually up 18%, beating the negative 2% return of bonds by a wide margin. We also made a couple macro predictions. We said that China is going to avoid a hard landing, and Europe's recession was not catastrophic, and therefore we weren't going to worry too much about what was happening in Europe. And I would say check on that one. China's GDP did slow, but it slowed to 7.7%, still making it the fastest growing large country in the world. Europe's economy contracted at a minus 0.5% last year, which isn't earth-shattering. It wasn't something that was mind-numbing and was going to cause us to have to make dramatic changes to our portfolio. In fact, the market enjoyed, for the first time, knowing that Europe was probably bottoming out. We said that non-U.S. equity markets are very attractive last year, and we believe that's still the case, but we're mixed in terms of the way we interpreted it. The developed markets, Europe and Asia, particularly Japan, they were up 23% last year. Very credible return, very surprising return, given what folks were thinking was going to happen to Europe last year. Emerging markets were a different story, led by China, India, and Brazil, and those stock markets, which generally fell, and Chinese stocks fell to, I think, their 2008 low again last year. Emerging markets were down 3% last year. So we had scattered money into both developed and emerging markets last year with mixed results. So our big themes really going into last year were threefold. We bought stocks, and we said we were going to buy stocks, and we were aggressive about it. We did not buy bonds unless the client specifically needed them in a portfolio and there was a unique situation behind it. And I think most importantly, we stayed the course last year. We ignored the pundits, we ignored the forecasts, we ignored all the noise, and just looked strictly at valuations and said this was the place to be in 2013. The Federal Reserve and central banks were priming the pump and giving us an impetus to go into equities that were still relatively cheap. And that staying the course, I think, was one of the most valuable lessons you could have learned in 2013, because you look at the number of investment managers who badly lagged the market last year. They did it because they tried to make forecasting bets. They tried to make bets on where interest rates were going and what was going to happen in Japan or what was going to happen in China. They guessed wrong. We stayed the course. We did not waver in our opinions about how favorable we looked upon stocks. We invested on facts, not fear, and that's something I promise that we will do every year for you. No matter what levels of fear are out there in the market, we look at facts first. And in the past few years, there have been lots of reasons not to buy stocks, and you hear them every day on television. Whether they were fears of the Eurozone, Obamacare, sequestration, hyperinflation predictions. Yes, there were still some of those, and there were still the gold bugs a year ago who have now disappeared. We had worries of a weak economic recovery that was still lingering in this country, record budget deficits, slow unemployment growth, congressional dysfunction. All these reasons were given over the course of the last year as to why you should not be in stocks right now. But, big but, stocks were cheap, and that was the bottom line to us. And these fears were driven, we think, by what we call recency bias. That is this generalized fear that 2008 could occur again, and therefore we always had to be on the lookout for it. Now, 2008, you almost have to categorize as a 100-year flood, and we know from statistics that 100-year floods tend to happen every 100 years. They don't happen every 3 years. So you can't be looking out for another 2008 or being worried that this is going to occur again. So we bought stocks. At the same time, we said bye-bye to bonds. It was a very bold move on our part, and we had to just turn over finance theory, which said that bonds should always be had a place in your portfolio, and they're always less risky than stocks. In a normal environment, that would be the case, but we are not in a normal environment. When bonds and treasuries got down to 1.8%, under 2% yield, you knew something was wrong. You knew that there was nothing but downside with bond prices as interest rates started moving back up again, that interest rates had probably bottomed when you had your money market rates at 0.1% from your bank accounts or even in brokerage accounts. You knew that rates had nowhere to go but up. And if they go up, you were going to get killed on the price. You might get your 2% yield, but you might lose 5 or 6 or 7% on price, and you were going to get a negative total return. And that's exactly what happened to bonds last year. So we've avoided them, and we purchased stocks that were paying dividends. We purchased preferred stocks of banks, and we purchased master limited partnerships, oil and gas partnerships. I wanted to give you a quick summary of what our asset allocation has looked like the last couple of years and how we've kind of adapted to what the market's thrown at us in terms of yields falling sharply and share prices falling sharply. This is a chart that's going to show our asset allocation in cash. These green bars represent our cash asset allocation across the entire firm from 2008 until now. And you can see here that we were averaging about 14% cash in March of 08. We let cash jump way up in late 2008, early 2009 to well over 20% for the average client. And then we've deployed that cash. We were not scared to go back into the market starting in early 2009. This was part of what we called a cash and courage strategy. For those of you who needed income in your portfolio, our goal starting in late 2008 when we saw the financial conditions really deteriorating was to try to preserve a year's worth of liquidity for you. For a lot of you clients who were living off your portfolios, we decided let's raise enough cash through the sale of stocks and bonds to make sure that the next year or so of your liquidity needs were going to be covered. And therefore, you didn't have to worry about what the stock market was going to do. We had it all covered for you. So that's why the cash levels jumped sharply in late 2008, and then we started deploying the cash. This was our asset allocation in fixed income. Marked by the red bars here, you can see that at one point, the cash and fixed income had swelled to more than 40% of clients' portfolios, and this is indicative of what we did with our cash positions. And then, over the last few years, our fixed income position has come way, way down to about 13%. Now, considering our client base and the fact that we are managing portfolios for a lot of retirees who generally need to live off their portfolios, 13% in bonds is actually a very, very low number. But this was a conscious decision we made. And over the same period of time, you can see what Treasury yields did. They were starting at about 4% in 2008, and they have slowly dove down. They got down to about 1.8% in middle of 2012, and they've started to move back up. So as we saw yields falling, we were getting people out of bonds. We were deploying cash because the market was really playing our hand for us and telling us that stocks were the best relative bargain out there. So this issue now of are we in a bull market or a bubble? You know, I would say a few points about, you know, our feeling about valuation levels. Broad market valuations right now are in line with long-run averages. And I would reiterate that point. We are in an average condition right now. The market is fairly valued. There are pockets of froth out there. You know, you can make the case all you want to whether Twitter or Tesla or Facebook are worth what they're trading for. We can ignore those portions of the market. They are just outliers at this point. The general market, the market that we're investing in, the types of companies we're investing in are fairly valued. They're not excessively priced, nor are they dirt cheap. And consumer and corporate leverage is low, which is something we keep an eye on. And as long as balance sheets are being repaired, particularly at the corporate level and individual level, we know that there's a lot of capacity, you know, for purchasing and consumer consumption going forward. So that is a good sign for our economy. Yes, sovereign leverage is high, and governments have now replaced corporations and individuals in terms of their debt levels, but that is not an imminent problem. It's something that's more long tail as we see it. Inflation stays modest. We're not going to see days of 6 and 7% inflation again, at least that's not in the cards. We think that interest rates are going to rise slowly, but that the core inflation that is on everybody's mind is going to hover probably around 2%, maybe even lower. We've got some countries right now in danger of going into deflation. So these are conditions that tell us that it's ripe for, you know, a good market appreciation going forward, and would tell us that the market really isn't in an overvalued state. And earnings growth is solid. As long as companies are growing, business values are growing. If business values are growing, stocks should escalate over time, although the rise going forward is not going to be that spectacular. And corporate profit margins are very high, but we don't think they're about to plunge, as some pundits have been predicting. Now the S&P right now, the S&P 500, is valued at about its post-war average. And that's an important indicator that you've got to keep in mind. The S&P right now is trading at about 17 times the past earnings, or 2013 earnings, for the companies that are in that index, and about 15 times 2014 earnings. And 15 times earnings is about the post-war average. Again, getting to the point that we're neither in an excessive froth, nor are we a dirt cheap market. Yes, and the market's in an all-time high right now, but that all-time high that we're referring to, that last high was hit 6 years ago. Earnings were 20% lower for these companies, and most importantly, businesses were frankly worth less than they are today. Don't be scared of a market that is going to an all-time high. If it's being accompanied by growth in business values, and economies are growing, sales are growing, businesses are growing, business values are growing, the market should go up with those businesses. And we've seen that. And the new highs to us are not a problem unless they're accompanied by excessive valuations. So we tend to ignore the fact that the S&P moved to a new high several months ago and continued to plow into a new high because we don't see the signs of the excessive valuations. If we did, we would take action. Let's put some of these market values in context. This is what the S&P 500 has done since 1999. You see a major high hit here, big collapse. This is the tech bubble. And we had a multi-year rally into 2007, 2008. The fantastic decline of stock prices. They fell about 47% from top to bottom. And then the huge meteoric escalation of prices, to what is moderate, where we are right now. But you got to put this in the context of valuation levels. In 1999, the average stock was trading for more than 30 times its earnings. They were destined to fall. They were destined to give very low, if not negative returns for a very long time because of that valuation level. And we saw that PE ratios of the market came down steadily. We had about a 9-year washing out of the stock market, and it took 9 full years to get rid of all those excessive valuations from 1999. By 2009, we'd probably overshot to the downside, and stocks were excessively cheap. You could start buying them, even by into 2010, 2011, you could buy stocks at 12 and 13 times earnings. Blue chip names were selling as cheaply as they had in 1982. This was an extraordinary time to buy. And you can see we're starting to see some escalation in prices and in valuations of these companies, but not to levels that should make you nervous, because valuation levels now are back to where they were in 2005, 2004. That gives us a comfort level that we know we're not buying into froth. And as I said, the market is now valued at about 17 times past earnings versus about 30 times in 1999. Why do we look at valuation? Well, it really does matter. There have been a number of longitudinal and statistical studies about valuation, and you can't underestimate its importance. It is the single most important variable that explains what equities are going to do over the next 5 or 10 years. Vanguard put out just an exemplary report about 18 months ago that studied all the factors that try to predict stock market prices, over the next, decade or so. And they studied everything from interest rates to currency fluctuations to who was in the White House to who was holding the Senate, who was holding the Congress, and where GDP was going. All kinds of factors that certainly get the attention in the news every day, but they found there was only one factor that importantly predicted where share prices were going to go, and that is today's valuation. The cheaper stocks are today relative to their earnings, the higher the returns you can expect over the next 10 years. If stocks are oppressively or excessively priced right now, you can expect very low returns over the next 10 years. So in our viewpoint, stocks no longer have this tailwind behind us. They're no longer dirt cheap as they were in 2009 or 2010, but it's not a headwind either. We're nowhere close to excessive valuations that would force us to pause and do a pullback from stocks. Our consumers are in good shape too. This is a chart looking at the average balance sheets of the American consumer, which shows their debt service payments or their interest and principal payments, as a percentage of their take-home income. In 1980 and again in 1994 or so, the average American paid about 10%, 11% of their take-home income in interest payments, principal and interest payments on the revolving debt. You can see from 1993 all the way to 2007 what had happened. Interest rates kept coming down. There was a lot of excess splurging in America, and this level got up to more than 14% in 2007, which literally means that about 1 out of every $7 you brought home in a paycheck was going out the door as a principal and interest payment, on something. Usually your house, or a second home, or it was your home, or it was your car. You can see what happened right after the bubble broke. That Americans have really repaired their balance sheets again. We're back down to levels of debt and interest payments, being about 10% of take-home income. These are very comfortable numbers to us. It tells us There is a lot of buying capacity, and it tells us there's not a lot of excess speculation in the economy right now. Corporations, which is what we focus mostly on, are in great shape. They are awash with liquidity. They have learned their lessons from 5 years ago. They are not going to let those mistakes happen again. The S&P 500 companies right now are holding more than $1 trillion in cash, and they can borrow at favorable rates. And many of them have locked in long-term debt for 2.5%, 3.5% rates a couple years ago. They're set. Their balance sheets are in exemplary shape. Here's 5 examples. Apple, Microsoft, Cisco, Google, and Oracle combined are holding $412 billion in cash and bonds on their balance sheet. If you took their cash and bonds off their balance sheet and formed their own separate company, you could call it Tech Cash Inc., it would be the 3rd largest company in the United States, just their cash. This is how safe and secure their balance sheets are. Berkshire Hathaway right now, a company run by Warren Buffett, he's holding $200 billion in cash, stocks, and bonds on his balance sheet. Rock solid balance sheet. We don't have to worry about these companies ever being afflicted again by a 2008 or 2009 financial crisis. Major banks have been hoarding deposits rather than lending. They are building their balance sheets. They've been doing it steadily since 2009. Nobody's really noticed it, but a company like Wells Fargo has earned $50 billion in profits since the bottom in 2009. It's also taken in about $229 billion in new deposits. So they've had $279 billion at their disposal to put back into the market. They've only lent $50 billion of that. The rest of it, they've been buying back stock, and they've been buying bonds with that money, rebuilding their balance sheet to make sure a 2008 or 2009 never has the effect on them that it did 4 and 5 years ago. And our industrials companies, and we've got a lot of them in portfolios, they're raising their cash flows. They're cutting fat. They've been doing extraordinary jobs of it based on the balance sheets we've been looking at the last year. They're cutting their tax rates where they can, and they're slowing their CapEx. They're not doing a lot of major expansion overseas or even in the United States. They are doing more with less, and they are preserving their balance sheets. They are in exemplary shape, depending on where the economy is going to go. But there's also a downside to what companies are doing right now. Raising cash and holding on your balance sheet is not always a positive. It just means that could signal lack of investment opportunities on the part of these companies. They're not willing to put money to work, and this is a conundrum that we deal with. The fact that we're excited to invest in companies, but these companies aren't very excited themselves to be investing in their own markets. They're not putting money into new sales forces and expanding operations and plants and capacities. In fact, industrial capacity for a lot of industries has been falling the last couple of years. Companies are very hesitant to put money to work that they've been getting from their profits, so they've been giving it back to us shareholders. And a lot of this money that these corporations have bankrolled the last couple of years is trapped abroad. We know that this is a big dilemma for our tech companies, in that in many cases 80% of the money that's on their balance sheet is abroad. And if they bring it back, they have to pay a 35% income tax on it, so it's going to stay on those balance sheets overseas. Washington, on the other hand, is not in the great shape. About 75% of the spending in Washington is defense entitlements. There has been no movement whatsoever in the past few years to deal with these areas and get that level of spending under control. And we don't expect to see that anytime soon. Our fiscal path in Washington is frankly unsustainable. You cannot run up these deficits without having a plan to pay it back at some point, and not having a plan to eventually run a budget surplus again, which right now does not look like it's in the cards. But we're getting a pass from the financial markets. We get a pass because our debt is denominated in dollars, and the dollar is still the only viable global currency. We get a pass because treasury markets and treasury bonds are the most liquid in the world. There is a readily supply and demand for treasury bonds. So anytime the government wishes to float new debt, there are eager and willing buyers to pick it up from them. And despite our political dysfunction, the U.S. remains one of the most innovative and productive economies in the world. And let's not forget about that. If you can ignore Washington and focus on the good stories in the United States, you can see that this is still the place you want to build a business. And I would just offer a question. Take a company like Facebook or Twitter. Could a company like this could have been started from scratch in a dorm room by some college student in a place like Israel or Korea or Poland and been built out to a $40 billion company in a matter of just 3 or 4 years? No other country has the legal, political, and economic infrastructure that will allow a Facebook to even occur, yet alone expand the way it has. So we got to keep patting ourselves on the back that our economy has the ability to regenerate and reblossom better than any other economy. And the good thing to remember, too, is that policy does not equate to profits and does not equate to stock market returns. Yes, Washington makes the news, but it does not make the stock market. Washington gets all the attention because of most of the policies they debate and pass affects all of us broadly. But the most important things we have to care about our investments are at the company level, the things that don't make the news. Companies have learned to make money despite bad policy in Washington, and they've learned to lose money despite good policy. So there is not a correlation between what goes on in Washington and what companies are doing. American companies have found ways for the last 60 years to build bigger and bigger franchises and widen their competitive moats in all their markets, despite what Washington has done or attempted to do or not done. Now, getting to this issue of corporate profit margins, this is something we've debated in-house as to whether we are reaching this kind of peak in terms of, are companies too profitable? Is there going to be a regression to the mean? This is a chart that which shows corporate profits as a percentage of gross domestic product, or basically how large are corporate profits as a percentage of our economy. And you can see, you know, they've averaged about 4, 5, 6% until the early 90s, and then they've shot up well beyond 10%. So corporates or corporations in their performance relative to our economy, you know, is almost double in size. And this has been a worrisome trend for a lot of folks who think there has to be a regression to the mean. And this is Pat's slide, by the way. Is this something that we need to be worried about? And I'm guessing that was the first time Pat learned to get a C+ on an English paper. And but it's not something that bothers us because we don't see mean reversion with corporations as likely at all. The U.S. economy has changed significantly since the 1950s, and I don't think there's any debate here in this audience. Mining and agriculture were once 10% of our economy. Now they're 1%. Mining and agriculture are heavily labor-intensive, with a very strong cost structure embedded with them, and they're not very profitable industries, and now they're only 1% of the economy, and they used to be 10. Manufacturing used to be 27% of the economy. Now it's only 10%, and that 10% is among the most efficient in the world. I would stack our value-added manufacturing plants up against anybody else's in the world, and you can see that we've gone from 27 down to 10 by basically farming out all the low-impact and the low-margin type of industries, everything from textiles to making toys and such, and we've kept the value-added engine making and such. So we've had a real good rollover of our economy the last 50 years that makes some of these past statistics very meaningless. Professional services and information, have vaulted. They once were only 6% of the economy. Now they're 17%. And when I say professional services, I mean financial services and banking and healthcare administration and advertising and industries that really didn't exist or flourish 50 years ago are now a huge portion of our economy, and they are constantly profitable. The industries that they replaced used to lose money every 3 years. These industries don't lose money anymore. They never have. Healthcare administration, healthcare in general has not lost money since it is, it really began as an industry in the 1920s. The capital intensity of corporate America has declined, certainly over the last several decades. It takes less input to create output, and it takes less fixed assets and hard assets and plants and machinery to create output as it used to. So therefore, companies are generating higher returns on equity and higher returns on their invested capital than they ever have before. And that should support higher valuations, and that should support higher profit margins. That's the way we look at it. In the broader perspective, you can take U.S. corporate profits as a percent of U.S. GDP, and you can see this kind of hollowing out trend where through the late 70s and 80s, corporate profits were only about 4.5% of GDP, and then we see this steady escalation over the last 25 years. But back in 1960, S&P profits were only 7% outside the United States. American companies made 93% of their profits here in within our own borders. Today they make 40%. So we would argue it's not even relevant to look at corporate profits and compare it just to U.S. GDP. We should probably compare it to world GDP. And when you do that, you see a more appealing trend to us that corporate profits as a percentage of world GDP is held pretty steady. It's about 2%. So our S&P 500 companies have basically been growing at the rate of corporate GDP over a long period of time, which is what we would expect now. So, is there excess speculation? Not in our opinion. Valuations are in line with historical averages. Broadly speaking, equities are not cheap, but neither are we in a bubble, which just means we need to be a little extra cautious when we're investing. Is there any economic dislocation? We don't see really much on the horizon. Interest rates are low, as is inflation. We see just very steady, maybe slow movements up in interest rates over the next few years. Earnings growth is solid. It's not spectacular, but it is solid and it's still growing, and we're seeing a lot of positive indicators out of companies the last 2 quarters that things are starting to pick up, both here and abroad. And we're seeing few signs of imprudent lending. The days where you could just go in and refinance your mortgage 5 and 6 years ago with no questions asked are gone. Try to refinance your mortgage these days, and you'll have to sign 50 pages of documentation and give a blood sample. I mean, this is how much our economy has changed just in the last 5 years. Government debt is high, but it's not an imminent problem. It's a long tail problem. So how are we doing with this? What are we doing with this information? First of all, I think we got to lower clients' expectations. You just came off a fantastic year, whether you were in fixed income or whether you were in balanced type portfolios or high growth portfolios. You got one of the better years that we've seen in a long time. So we've got to lower your expectations and say that what you saw in 2013 is likely not going to be repeated. We're avoiding bonds. We're still avoiding bonds. We're favoring dividend-paying stocks, as we've been doing for the last 3 or 4 years, and we're adding master limited partnerships, oil and gas partnerships for income for clients who need it. And we're growing our clients' capital by focusing on margins of safety. That is, looking for pockets of valuation that look appealing to us, looking for companies that are still priced for returns that could satisfy your individual needs. And we're looking outside the box when appropriate, looking for kind of alternative investments. When it comes to lowering expectations, we got to let you know that equity returns for the next 5 years will almost certainly be lower than they were the last 5, and volatility in the stock market is going to be higher. So prepare yourself for more up and down fluctuations in the stock market, whether it's on a weekly basis or even yearly basis, and prepare yourself for returns that can't compete with what we saw the last 5 years. Over the last 5 years, stocks ran up 16% annually. That's an astounding return for a 5-year period. And over the same period, the earnings of these corporations rose only 9.5% a year. A little bit of a dichotomy. And that told us that valuations crept up and that PE ratios kept increasing. 5 years ago, the S&P 500 was valued at only 12 times its earnings. This was the trough of valuation. Today, it's at 17 times earnings. But once you get to a point of where the market is fairly valued, and that's a common term we're going to be using this year, at a level of fair valuation, it tells us that we would expect equities and share prices to rise in line with corporate earnings. If corporate earnings rise 6% a year, we would expect 6% growth and appreciation in the stocks. That's what fair value means to us, and that's what we could expect. Now, in terms of managing expectations, we got to admit that the market simply in 2013 borrowed returns from the future. This is a chart, I don't know if you can see it way in the back, but these are some of our favorite companies that we put in a lot of portfolios, and these were our projected returns for these companies had we bought them last January 1st of 2013. Like 3M Company, when we looked at it and the way it was priced a year ago, we thought we could get about a 9% long-term return out of that stock at that price. Well, what happened in 2013? We got 53%. We got nearly 6 years of returns baked into one. So that tells us we got to be a little more cautious about a 3M stock, that it has probably borrowed some returns from the future and that we can't fully imagine that we're going to get anywhere close to that return going forward. Like I said, we were looking for a 9% return per year over the next 5 years out of 3M. We got 53 in 1 year. Going down the list, you see a lot of our other favorite companies that were priced very attractively a year ago. BlackRock was priced for about a 12% return, DuPont 9%, Google 17%, Johnson & Johnson we thought was very attractive a year ago. And look at the returns we got out of those stocks in the course of 1 year. Same thing with Lockheed Martin, Microsoft, Nike, Paychex, Starbucks. We were expecting decent returns a year ago, but now you can see we got several years of returns baked into one. So this is another reason why I think we need to lower expectations. On the equity side, we want to deal with margins of safeties. And we know that with valuations really in mid-levels right now, we would like to see that, that clients have some insurance against pullbacks. But unfortunately, most of the insurance that you could go out in a sophisticated insurance is pretty expensive or ineffective. Whether you're hedging through options or market neutral strategies or structured notes or putting money in hedge funds, it really hasn't worked the last couple of years. And the chief reason is there was a lot of macro forecast baked into those types of products. Most hedge funds, nearly all hedge funds, and most active macro money managers have badly lagged the market for 3 years. They were trying to offer you protection, but what they did, they protected you at the wrong time. And to try to protect yourself now is still a very ineffective strategy. So the insurance that we look for in equity portfolios, and the way we try to think about protecting, is number one, careful attention to valuation. If a stock is priced for a very low return and is priced for 30 times earnings right now, it's likely not going to stay in portfolios, or it's going to be, we're going to watch it very closely. It's not going to be something we're going to be aggressively buying. We're still going to be looking for pockets of profitability, companies that maybe didn't participate in the last 18 months of rally. And if we get those types of companies and we can put them in portfolios, we think we can still get some good returns for you. And we only own businesses with a structural competitive advantage or economic moat, as Pat or Warren Buffett like to say. We ignore a lot of companies. Our team of analysts spend our time honing our analysis of maybe 90 or 100 companies tops out of the thousands that exist out there. We've already picked the 90 or 100 we think would best suit your portfolio, and then we kind of cherry pick from that list the best 20 or 25 at any one time we think should go in portfolios. So by virtue of the fact that we ignore a lot of industries, everything from auto to mining to airlines to highly cyclical industries, we already think we have bestowed a natural advantage into your portfolios by putting types of companies in there that have sustainable growth to them. And if we can pick them off at good prices, we think that's probably the best solution. And we hold a little bit more cash. We know that with frothy valuations building up in some pockets of the market last year, we took some money off the table. Some stocks had run up quite a bit. We have not replaced that money yet. So if you see a little extra cash in your portfolio and you want to talk with your portfolio manager about it, it probably reflects the fact that we saw a few extra froth valuations developing within the portfolio. We took a little bit off the table. We're going to redeploy it. We look at that as dry powder right now. On the income side, I've already said that bonds aren't our preferred option unless you need liquidity or you are averse to volatility. If you need liquidity, stick with bonds. If you absolutely need a fixed level of income for the next couple of years and you can't afford the volatility that the market can offer you, stick with bonds in portfolio. We've been doing that with a number of clients with laddered bond portfolios where we have an X amount maturing every year between now and, let's say, 2018. Or if you have grandkids that are going to college and you're funding their education and the kids are just 1 or 2 years away from college, those are the types of portfolios that I would say you've got to stick with bonds on. Further, if month-to-month volatility can cause you to sell irrationally, if every movement in the market worries you, put some bonds in your portfolio, and we'll help you put those bonds in the portfolio. We'll help you just kind of, we'll neutralize your nervousness, so to speak. And this is going to happen. But if you can't stand being fully invested, and if you can't stand watching the market even fall 2 or 3% from its high, you should not be fully invested in stocks. There needs to be a cash component. There needs to be a low volatility component in there. But if you can focus on income stability and tolerate short-term principal volatility, look elsewhere. The problem with owning bonds is the fixed nature of the coupons. The coupons don't rise, and right now you're getting a near zero rate return. A lot of bonds are yielding only 2 and 3%. You've got inflation of nearly 2%, so you're getting a real return of only 1%, and if you're owning treasuries, you're getting negative real returns in some cases. Negative real returns. You're lending money to the government. You're giving money to the government, and what they're paying you back for lending them money isn't even covering inflation. So what have we done? We put folks in our equity income portfolio, and our equity income portfolio is basically dividend-achieving stocks. The Johnson & Johnsons, the Colgates, the Coca-Colas, the Paychexes, the AT&T, the Verizons. These types of portfolios right now are yielding 3.6%, and the dividends are growing at 5%. So they think of these as bonds. Johnson & Johnson right now is a bond with a 3.5% coupon, and that coupon's going up at about 6% a year. If you look at Johnson & Johnson that way, and it throws off enough income to supplement your needs, you don't have to care about the fluctuations of Johnson & Johnson stock. And by the way, Johnson & Johnson has a very low beta. It fluctuates only about 60% of what the S&P 500 does. Our high income portfolio, which is something that Pat and I run, it's yielding 5.4% right now, and it's got a 3% growth rate in the income stream. So you're getting a 5.4% yield, and if the share price appreciates along with the growth rate in the income, you're getting about an 8.4% total return. We like that a lot better than bonds right now. I mean, these are much better options than bonds for investors who are comfortable with this kind of short-term volatility. Our high income portfolio, which I believe we now have about $60 or $70 million invested in across the board for clients, as I said, it's yielding 5.4%. It's got 3% income growth right now. Pretty attractive relative to bonds. That portfolio was up 12% in 2012, up 18% in 2013 versus a -2 for the bonds. This was a very suitable, timely alternative to going into fixed income. And we still think it's attractive here in 2014. And the volatility of this portfolio is about 40% less than the S&P 500. So you're getting much higher returns in bonds. You're getting much less volatility than the stock market. You're going to get more muted returns than what the market gives you. But if you're looking for only 2 and 3% in yield and a little bit of appreciation above it, this portfolio I think is most suitable. And the holdings are all liquid and they trade publicly. 30% of these portfolios right now are in bank preferred stocks. These are kind of an interesting twist. A lot of our major banks issue these preferred stocks, trust preferreds they're called, and they're going to need to be called between now and about 2016. So they're hovering around their par value because the market knows they're going to be called. And in the meantime, until they're called, we're going to collect a 6.5% yield on these things and let them move up and down a few pennies a day. And we get a very stable 6% yield out of them. About 65% of these portfolios is going into master limited partnerships, mainly oil and gas pipelines or storage facilities. And we're getting yields between 4 and 8% on these types of investments. And we're getting excellent income growth and the tax efficiency, because even though they're paying out 4 to 8% in terms of what we traditionally think is yield, a lot of this yield, sometimes 60 to 70% of it, is a return of capital that won't cause you taxes near term. It'll lower your cost basis, so when it comes time to sell, you'll have capital gains tax at 15%. It's a wonderful vehicle, for kind of deferring taxes and getting you a much higher yield. Now, the pros of this high income portfolio is that you're going to get higher current income than the bonds. You're going to get the inflation protection because a lot of these companies are raising their distributions every year. You're getting just modest interest rate risk. In fact, because you're dealing with oil and gas type assets, there's a built-in inflation protection there, and you're getting materially lower volatility than equities at a very tax-efficient manner. The cons are it's not really suitable in a non-taxable account. You can't really put a lot of these MLPs into IRAs or tax-deferred accounts. And there is a little complexity in terms of the tax filing here, and a minor risk that MLPs might lose their tax status one day. There's every year or so something is submitted in Congress to try to reduce the tax liability or take away the tax favorable status that MLPs get, but that usually dies in Congress. Now, we're managing most of our assets internally. In fact, probably more than 95% of them. We use outside resources for just a minority of our assets, recognizing that we just can't do everything in-house. We're not experts in Brazilian retailers or Greek retailers, and we understand that, and we've found ways to diversify internationally. We use a company in Austin, Texas called Dimensional Fund Advisors, and we've been putting some of their mutual funds in some of your portfolios for international and emerging markets exposure. They've been a wonderful diversification tool for us, and they are tremendous tax and cost efficiency to getting into emerging markets on the cheap. We also have partnered with a hedge fund out of Chicago. This came with a relationship that Pat has known with the portfolio managers for a number of years. These folks deal in distressed assets and concentrated long-short portfolios, and for the last 18 months or so, we've been introducing this to clients. And then Pat himself has just launched a new product called Global Moat. He's taken his concentrated moat portfolio, where he's looked at companies with competitive advantages, and he's broadened it. So now you've got a portfolio of 15 or 20 global companies that we think would give excellent diversification. So to wrap up, I'll just summarize in a couple quick bullet points. We're not forecasting the market. We don't try to forecast where the market or the economy is going, and I wouldn't listen to anyone who says they can. The advice is worth what you pay for it, and most advice is being gotten from television right now, and how much are you paying for that television advice? That's all it's worth to us. Equities to us are not in a bubble, but neither are they cheap. So keep your expectations modest for 2014. We are. Focus on reasonable prices and great businesses. Great businesses is the the mantra of our organization. Make sure the companies can grow into their share price. And that's the one thing we're watching most carefully right now. Yes, the prices are elevated over the last year, but if we see that some of these companies can accelerate their sales and earnings over the next year, they'll grow into their share price. And that's what I think the market's anticipating. And then look abroad. Emerging markets are quite cheap right now. You heard a lot of talk in the last week about emerging markets are a place to avoid. That's for the traders. That's for the folks who just recently put on the position and are trying to report to their institutions every week or every month what the returns are. They can't be caught dead holding the emerging markets at the moment. We think it'd be an excellent place to put money. We think bonds remain a poor bet for income unless you need liquidity or volatility is a major worry to you. So to wrap up, and before we open up the Q&A, I would just say to our clients, I'm grateful that you're all here today. I hope we've been able to answer some of your questions or at least fuel some thought for you. And we promise to keep working hard and deserve your, and deserve what you've done for us. So thank you very much.